Hi, I'm Mike Gasowitz, CEO of TriCert Financial Group. Welcome to a special series we're calling Echoes, all about legacy planning. And today we've got a really good topic. We're talking about unraveling the complexities associated with tax when it comes to legacy planning. We've got a special guest today. Joining us is Dylan Domenico, a partner from one of our affiliated CPA partner firms. Welcome, Dylan.
Thanks, Mike. Good to be here.
Good to have you on. And also joining us is Oliver Lee, who heads up our insurance practice. Welcome, Oliver.
Hi, Mike.
Okay, guys, so let's dive into it. Maybe, Dylan, I'll toss the first question to you in terms of legacy planning. At the end of the day, we're talking basically about death. So maybe we'd start with, talk about the taxable events in this case.
Yeah, so just in general terms, any transaction or event that leads to an inclusion in taxable income on an income tax return is considered a taxable event. Your most obvious are your everyday situations, such as your employee receives a salary payment from employer, results in taxable income. Then there's the disposition of assets. So you could sell stocks in a non-registered investment account, the family cottage. These are taxable events, possibly triggering taxes on capital gains. The less obvious taxable events are typically caused by what are called deemed dispositions, where no actual sale of the property takes place, and in some instances, no asset actually changes hands. So changes in use are common deemed dispositions. For example, say you own a rental property and a tenant leaves, and then you move into the rental property as your personal residence. So this would typically create a taxable event unless certain elections are filed. A big one that comes as a very unpleasant surprise to a lot of clients is the death of the taxpayer, resulting in a taxable event. So unless there's a surviving spouse for assets to roll over to tax-free when somebody dies, all capital assets that are owned are deemed to be disposed of at fair market value on death of the taxpayer. And this should definitely be planned for in advance, as there's ways to mitigate the tax burden here.
So typically, so you said there, in terms of it, if the spouse is still alive, then that may not necessarily be a deemed disposition.
Correct. So the Income Tax Act allows for a tax-free rollover to a surviving spouse, even if certain assets, capital property has an unrealized gain that would otherwise be taxable if it were deemed to be disposed of.
Okay. Does Canada have the notion of an inheritance tax? Is there such a thing?
So what you're likely referring to is probate in this situation. So Canada has probate. Each province mandates it separately. There is one province, I believe to be Manitoba, that may not have a probate tax. And between the different provinces, the rates of probate are different and they vary. This is essentially a fee for the court's legal process to register and accept a deceased person's will when they pass away. And this is required before any assets can be distributed to the beneficiaries of the estate. This is often also referred to as estate administration tax, as you've likely heard it before. So right. Here in Ontario, the rate of probate is 1.5% on the value of the estate in excess of $50,000. So they basically give you a break on the first $50,000. And in certain provinces, it's really just a nominal flat fee instead of a rate on the value of assets going through the estate. But that being said, there are some pretty simple but very effective probate minimization strategies that we advise on for clients. Just to name a few, setting up beneficiary designations on registered investment accounts. This results in the transfer of those investment assets from those registered accounts outside of the estate itself, so it doesn't have to go through the probate calculation. Another very common one, and this is one of the most common recommendations as it relates to estate planning that I see in financial plans, is for our corporate shareholder clients to have a secondary will to address those private corporation shares. This often results in the value of those corporate assets avoiding probate and can result in very significant probate savings.
Okay, yeah. So that makes sense, Dylan. So and you touched upon it already, but talk about what are the elements that are taxable and other elements that wouldn't be taxable from a CRA perspective.
Right. So when somebody passes away, there's a few different layers of what could be taxable. For example, when someone has registered investment accounts, they might have an RSP or a RIF. The full value of that RSP or RIF is included in taxable income in the year of death. If you have, let's say, just cash where there's no unrealized capital gain on that cash, there's really no income there. So there's no capital gain and no income tax calculated on transferring that to beneficiaries of the estate. It's when there's an unrealized gain on capital property. So for example, there's a non-registered investment portfolio of the deceased taxpayer. Those investments went up a lot in value over the lifetime and hadn't yet been sold. So those are deemed to be disposed of in the year of death. So the difference between cost base, which is usually what the taxpayer bought it for, and the net proceeds, so after deemed proceeds after transaction costs, would be a capital gain. So then there's a lot of talk surrounding the inclusion rates of capital gains now, given the looming inclusion rate change on June 25th. But it's the inclusion rate that's applied to the capital gain itself to determine the taxable capital gain. And then that taxable capital gain is applied at whatever the applicable tax rates are. Could be the individual's marginal tax rates if it's a personal capital gain, in order to calculate the tax payable.
Okay, that's good to understand that and clarify that. So, we talk about the inevitability of death and taxes. Can't avoid that line, but it is the truth. But there are ways, I think there are things we can do we'll try and minimize that if possible. So let's talk about planning ahead. This is what this whole series is about, planning ahead. So maybe Oliver, I'll put you on the spot here and talk about the value of planning ahead on this front.
Yeah, absolutely, Mike. I think the primary thing when we work with many clients is our first focus is making sure that the intentions of our clients in terms of their assets and how they want it distributed and who they want to benefit from those assets, that happens. That there's a plan in place to ensure that, listen, if your business is supposed to go to certain of your children or your assets are going to a charity, as an example, that we want to make sure that that plan is in place to ensure that that actually occurs. So, the taxes aside, ensuring that the client's wishes when they're no longer on this earth actually get fulfilled after they're gone. So that's the primary reason, and planning ahead allows us to do that, put all the pieces in motion. The other kind of big component is that some of these strategies, it takes time to kind of explore to see if they fit the client scenario, and in some cases, even if they're eligible. So, if we didn't have that time to do some of this planning. So as an example, Dylan mentioned a multiple will, a secondary will for your business. That's not something you can create after you're gone. That's something that requires some pre-planning to kind of get done. So we're quite focused on trying to encourage our clients to kind of think ahead, so to allow us to help them with some of these planning ideas.
Dylan, anything to add to that?
Yeah, absolutely. And matters get more complex, and it opens the door for more planning opportunities when you're dealing with corporate clients, so owners of private corporation shares, that it's either an operating company with a successful business and an accumulation of, cash and other assets within that business, or simply an investment holding corporation, which could have resulted from the sale of business assets before, and then there had been investment growth until retirement for the taxpayer, for example. There's certain restructuring strategies that could be put in place, such as an estate freeze, to kind of kick the can down the road and defer income taxes on death, where essentially the growth shares, typically being the common shares of the corporation, are exchanged for shares that don't grow in value to the same degree. And growth shares are issued to the next generation, for example, children who may plan on taking over the business at some point. And there's also corporate life insurance planning as well, in order to minimize the taxes on death in very specific situations.
So that's good. You're basically going at, talking about the complexities and the opportunities there for owner operators. So let's shift to that a bit more. And you mentioned insurance. Oliver, anything you want to add on that?
We do work with many business owners. The two, when we meet with business owners, probably the two kind of key parts of tax that we focus on and we see if our issues or we do some planning on are liquidity to fund the ultimate taxes. So to Dylan's point, if you've got a successful ongoing business that you plan on passing to the next generation, as Dylan had mentioned, unfortunately, there will be some capital gains taxes due on those shares. There may be capital gains taxes. So one of the things that we determine is, will your estate have the liquidity to fund those taxes? CRA, unfortunately, they're not keen on taking anything other than cash. That's their only accepted form of payment. So if you don't have the cash or it's very difficult for your estate to come up with the cash, then that's something that we want to identify and see if we can solve. So that's kind of the one end of the spectrum. And then the other end of the spectrum is we work with business owners that have almost the opposite, not problem, but situation where they have a lot of liquidity and they've built up significant wealth inside their corporation. In those situations, without proper planning, there can be significant tax bills to get ultimately that excess capital or excess wealth out of the corporation. So some planning really may be beneficial to see if we can minimize the tax to get it out of the corporation.
Oh, that's good information, guys. Let's talk about, obviously we're Canadians, Canada, but close to the United States. And so we have many clients who have, call it cross-border associate. Maybe they have assets in the U.S. Maybe they're holding a U.S. passport, what have you. Let's talk about that. I think that probably adds a level of complexity. At what point does the client need to be, at what point do we need to take those things into account?
Yeah, so it would make sense for a client with any sort of substantial U.S. ties, whether that be a U.S. passport, whether that be, let's say they own a Florida condo, for example, to have a professional tax advisor who is familiar with those cross-border rules. And in the case there may be, U.S. tax implications on a Canadian tax return to do with taxes paid in the U.S. in certain instances. For example, claiming of the foreign income tax credit on the Canadian return and so forth.
Okay. Oliver, anything else to add on the U.S. front?
I echo Dylan's comments that it does get much more complicated when dealing with some sort of U.S. connection. The U.S. estate taxes are very different than what we have here in Canada, and they can be significant. I think it's very complicated, and when we have those situations, we definitely flag them and recommend to the client, similar to what Dylan said, to seek an individual that's very knowledgeable on cross-border taxation issues.
Okay, that's good to know. So you guys have touched on a lot of the issues, the complexities. It's clearly not trivial, that's for sure, and yet there are good gains to be had by, doing the planning up front. And I guess, so that's the next question. We call it the last question. Who should be involved in this planning? Maybe Dylan, why don't we start with you? What are your thoughts on that?
Yeah. So my philosophy is that, a client is best served when their CPA, so their tax professional, their financial planner, and their investment manager, all three professionals are working together. And as the situation may call for, if there's some sort of insurance solution or risk management solution, they should also have an insurance professional as well. There are a lot of moving parts that are interrelated between these financial disciplines. And the end result when there's collaboration between these professionals on behalf of the client is typically a more tax efficient situation and, a more comprehensive solution as it relates to tax planning strategies and overall financial planning strategies.
Which is why we exist. So, makes total sense. And, Oliver, anything you want to add to that?
Yeah, I would echo that too. I've certainly been in some situations where the outcome is the best when all the professionals at the table. Every professional has a different perspective and a different area of expertise, and it really is an incredible outcome when they all work together to look in the client's best interest and develop a solution.
Makes sense, guys. Thank you so much for this.
Thanks, Mike.
As always, folks, if you have any questions, don't hesitate to reach out to your CPA or your CPA firm's financial advisor, your portfolio manager here at TriCert Investment Counsel, or don't hesitate to reach out to myself. Take care.